In 2022, we've seen a number of pressures on financial institutions. One of the primary ones is deposit pricing and how they retain those deposits and garner those customers. Institutions are deploying a number of strategies to figure out how to keep their liquidity ratios in place by growing deposits while they're growing the lending. Some of those strategies include how they price the deposits, tying deposits to bigger relationships with customers or all-inclusive relationships with customers in an effort to bring more business into the institution and keep it all contained. In 2022, we saw 7 hikes in interest rate risk from the Fed. Many institutions are evaluating their interest rate risk and have been continually throughout 2022 to figure out how to protect themselves from burdensome increases. A lot of those institutions are evaluating the runoff in their portfolios and trying to determine how they're going to reapply that capital either into lending or preserve it and see what the ultimate outcome of rate increases is in 2023. In 2022, there were several issues that institutions had to deal with. One is liquidity. The issues around keeping your liquidity intact have been addressed in a few ways. One is leveraging their Fed funds ability to borrow money to offset their liquidity ratios. The other is to more frequently analyze their portfolios and use that runoff in lending to beef up their liquidity. And then others are looking at participation loans as a way of keeping the relationship with their clients, pushing some of the lending balance out of the institution while keeping their liquidity ratios intact. Cybersecurity is always top of mind for financial institutions, being a highly targeted industry. In 2022, we've seen the offenders become more educated and more technically savvy, and the institutions having to respond. Having been in an environment where they've had employee training programs in place that are kind of the same year in and year out, we're seeing a lot of energy put into employee training as it's become the biggest and has been the biggest threat to the institutions and their providers. As it relates to governance of financial institutions in today's world, cybersecurity is huge. Governance over the board and the cybersecurity programs is critical. We've seen an evolution where it's a requirement by the regulatory bodies. Some boards reach out and garner training or updates on an infrequent basis, which really is proving not to be enough. I think where we're at is probably an evolution of boards today where they're putting full-time cybersecurity expertise on those boards and maybe in trade for what historically have been board members from the medical community, legal community, business owners, local governments. Third-party risk management has become an increasingly important issue for financial institutions. With more and more reliance on third-party providers and not in-house supported services, the oversight of those providers has become key. That coupled with the cybersecurity problems those providers face, and at the end of the day, if they suffer a breach, it's really the institution's name that's out in the market. The oversight of those providers needs to have more attention from the board and from management. Where we see that being escalated is really in the due diligence organizations are doing on their third-party providers, making sure they have a proven track record of supporting financial institution-type clients, and that they have the appropriate security and infrastructure controls in place to protect the bank's data. Regulatory scrutiny over fee has created undue pressure for the institutions today. Fee pressure is not an uncommon issue for institutions to deal with. They've dealt with it for decades, where fees go away, new fees come out, regulatory oversight, fair lending issues. I believe institutions are leveraging third-party providers to minimize some costs or make cost savings in their operational budgets. I think they're also looking for ways to leverage lack of fees as a mechanism to gain entirety in relationships with customers rather than just a single transaction. In anticipation of continued pressure on regulatory oversight of fees, I think that bankers should expect more regulatory scrutiny on their fee structure for the existing ones as well as any new fees that they implement in the future.